Last week, France said it was cutting 2 public holidays as the government targets more spending cuts. Prime Minister Francois Bayrou is targeting about $50.9 billion worth of savings to reduce the budget deficit level from 5.4% to closer to the EU's 3% target. 3,000 civil service jobs could be eliminated and tax breaks for the wealthy could also be affected. France is looking to reduce its stake in state-owned companies as part of these measures. Another story catching our attention late last week was the passing of crypto-friendly legislation in the U.S. Congress. On Thursday, Congress passed the Genius Act, which regulates stablecoins, also pegging them to sovereign currencies, typically the U.S. dollar. There were 2 other bills clarifying oversight of digital assets and how securities are defined and banning the Federal Reserve System from issuing digital currencies. The bills protect American consumers, protect their investments, and could bring more capital back to the US and make the United States a fintech leader in payments and in digital assets. Hello, this is Bode Oshosami, and welcome to Global Business Insights, where we look closer at headlines moving markets all over the world. First, on the Genius Act, where the major banks CEOs, JP Morgan, Chase, Jamie Dimon, said his bank was going to be involved in both JP Morgan Deposit Coin and stablecoins. And Jane Fraser, Citi chief executive, said it was enthusiastic and welcomed the administration's willingness to allow banks to participate in the digital asset space more easily. The new law requires stablecoins to be backed by liquid assets such as US dollars and short-term treasury bills, and for issuers to disclose publicly the composition of their reserves monthly. Trump is reportedly also preparing to sign an executive order that would allow the $9 trillion US retirement market to invest in cryptocurrencies like Bitcoin, gold, and private equity through their 401k plans. Meanwhile, critics are warning that the new legislation lacks the basic safeguards necessary to ensure that stablecoins don't blow up the entire financial system and poses grave risks in the event of another market crash. The FTX Sam Bankman-Fried scandal and all the fallout that was in November 2022 with all the misuse of funds and securities fraud led to call for increased regulation of cryptocurrencies. You could call the Genius Act a beginning, but unlikely to be all that is needed to curb potential crypto-related excess. Indeed, many agree there is need for better scrutiny unlikely to come from a U.S. administration that was voted in, promising to lighten regulatory burdens to make the U.S. the world's crypto capital. Just ahead of the act passing, Bitcoin surged to over $120,000 as we continue to see the mainstreaming of crypto in the US. The crypto sector's market value also hit $4 trillion on Friday, reflecting its shift from a nascent asset class to a more central part of the global investment landscape. In another article last week, Michel Flournoy, co-founder and managing partner of West Exec Advisors, warns that America is building some advantage trying to use tariffs and legislation to maintain its position as the strongest innovation ecosystem in the world, with the best chance to lead in the artificial intelligence era, but is also neglecting more important foundations of competitiveness. Though it has the engineering talent and capital markets, he stresses in the article that advantage does not self-execute and requires as well robust investment in science, workforce policies that attracts and retains top talent, and stable rules to unlock longer-term capital. There is a race to be the country that learns fastest, builds fastest, and scales also the fastest, the country with the greatest capacity to shape the future. To be that country, foundations must be rebuilt and not dismantled, and institutional safeguards and regulatory guardrails are an important part of that reconstruction to avert a disaster waiting to happen. Our next deep dive is about scrapping Easter Monday as a holiday in France and Victory in Europe Day, marking the surrender of Nazi Germany, ending World War II. Both holidays already occur in a month of full-long weekends, and abolishing them, we hear, could help economic activity in businesses, shops, and the civil service, thus improving productivity. France is also examining what it calls a solidarity contribution from the wealthiest. For France, the threat of being crushed by debt has become real. Now 114% of gross domestic product, and debt service weighing more on the budget. The French Prime Minister alerts that France is at the last stop before the cliff as an aging and increasingly impotent Europe is heading for bankruptcy unless it embraces major change, with digitization, decarbonization, and defense all needing to be financed against this backdrop of demographic decline, high debts, and crippling deficits. To make matters worse, France must refinance maturing debts at much higher interest rates than monies borrowed for next to nothing between 2014 and 2022. I can't help but look at the fiscal situation in Nigeria, also in need of a transformation catalyst, desperately in need of significantly higher spend in infrastructure and welfare support, as inequality stokes huge discontent amid domestic and international borrowing financed at much higher costs than obtained a decade ago. The question: is the Tinubu government doing enough to tighten the fiscal belt? Holidays are routinely granted, already given the average of national holidays from 2021 to 2025 came in at 16, almost a week more national holidays than in, say, France, before cutting off 2 more days. The wealthy are also not being asked to contribute more. And like was observed in a previous episode, African nations are noted as doing the least to address what is already far higher inequality than the global average. All can learn from France, as the context in the second half of the year suggests more economic tepidity, higher costs, and tighter fiscal purses, even for resource and commodity-rich economies. Now to other business stories. U.S. Commerce Secretary Howard Lutnick, after getting off the phone with the European trade negotiators, that was yesterday, says he was confident the United States can secure a trade deal with the European Union, but adding that August 1 is a hard deadline for tariffs to kick in. He added that so far there was plenty of room for agreement. The US was also reported to have escalated demands to the EU for at least a minimum tariff of 15 to 20% in a deal with the Eurozone set to be close to final stages. Trump was unmoved by the latest EU offer to reduce car tariffs and is insisting on reciprocal tariffs that exceeds at least 10%, even if a deal is reached, arguing that non-tariff barriers by the EU cannot be ignored. On Thursday, the European Central Bank Monetary Policy Committee, led by President Christine Lagarde, along with fellow policymakers, will gather for a crucial meeting. The ECB is expected to hold rates at 2%, and according to insight from sources within the ECB Governing Council, it suggests that the US President Trump's tariff warnings could have significant repercussions. If talks deteriorate and the possibility of imposing, say, 30% tariffs on EU imports become imminent, the ECB might consider implementing rate reductions. Last week, we saw Wall Street ending on a somewhat subdued note as investors cheered comments by another Fed boss, Christopher Waller, favoring a July rate cut, but also as Chicago Fed President Austin Goolsbee said he was wary due to the latest CPI report, showing first signs of tariffs pushing up goods inflation. We also got the University of Michigan consumer sentiment data for July, showing households were more optimistic about their financial situation and now expect inflation to inch lower. The University of Michigan's preliminary consumer sentiment index rose to 61.8 from 60.7 in June, better than the market expectation of 61.5. Ghana's central bank said on Friday that an emergency meeting of its Monetary Policy Committee held, that was last Thursday, at which it considered taking immediate action on monetary parameters, but held off until a regular meeting later this month. The bank noted in a statement that a broad range of macroeconomic indicators had improved as it emerges from its most severe economic crisis in decades. And in Nigeria, the Central Bank of Nigeria Monetary Policy Committee is meeting and will decide on interest rates and other parameters amid some stickiness in inflation. There are signs that tightening was holding back rising prices, albeit at a cost, weighing on economic growth. But the MPC is still likely to conclude tightening still needs more time as it cautiously signals future cuts. South Africa's rand, government, bonds and stocks all gained on Friday as a two-day group of 20 finance ministers meeting ended under its presidency, and where participants agreed a final communique, the first since October 2024. U.S. Treasury Secretary Scott Bessent was absent from the meeting as Washington is set to assume the G20's rotating presidency in December. The communique stressed the need for central bank independence, multilateralism, and importance of the World Trade Organization, adding that the body needed reform. Washington was reported as saying they are leaning to a back-to-basics plan when they take over the presidency. Saudi Arabia's sovereign wealth fund is reported to be reassessing its flagship $500 billion futuristic city called The Line. The Public Investment Fund is using consultants to conduct a strategic review into the feasibility of the 105-mile linear city located at Neom, a huge new development in Saudi Arabia. Neom says strategic checks are common practice on long-term mega projects, but the move comes amid global scrutiny of Saudi Arabia's ambitious infrastructure agenda, with growing pressure on public finances as crude oil prices struggle. It's almost inevitable that the project will be scaled down. China kept its benchmark lending rate steady as it copes with weak consumer sentiment and softening growth. The one-year loan prime rate was held at 3% and the 5-year loan prime rate at 3.5% by the People's Bank of China. Asia-Pacific markets hold their ground as investors monitor the latest developments on the trade front. In Japan, where there is a market holiday, there is some anxiety as the fate of Ishiba Shigeru, Japan's prime minister, hung in the balance after his Liberal Democratic Party and its coalition partner Komeito lost their majority in the upper house of parliament, a development which has been priced in but is still expected to shake up the country's politics and stoke some uncertainty. Wall Street futures are bracing for earnings from the first of the tech giants, with Alphabet, Tesla and IBM reporting this week. Oil prices inched up as increased supply from OPEC Plus is offset by the risk that European Union sanctions against Russia for its war in Ukraine could materially curb its exports. Brent still under $70 in early morning trade. Well, that's it on this episode of Global Business Insights. This is Bode Oshosami. Thanks for watching. Bye-bye.